Good afternoon, Patrick Dwyer and Greg Pool here at NewEdge Wealth in Miami, the Align team. Greg, what are we talking about today?
So today we wanted to follow on to our last conversation we had about what to ask your advisor. We want to continue to make clients more informed about asking the right questions. We're going to cover three topics today. It's really important that you understand how your advisor thinks and handles these things. And so we wanted to cover these topics and give you our informed opinion. And those are active and passive investments in equities. The second is how to think about after-tax returns. And the third is the impact of fees on performance. I'll turn it over to Pat and let him start on active versus passive in equities.
We're going to talk today. First, we're going to look at active management and the persistent underperformance across time horizons. This is a very big deal because about half of the money out there today is in active strategies, and they just don't work. What are the facts? The facts are, on a one-year basis, 65% of active funds underperform before tax. 5-year, 74%, 10-year, 85%, and 20-year, 93%. And that includes this massive survivor bias that you have where a lot of companies go out of business and they drop out of these indexes. So it's probably worse than that. But it is sort of astounding that 93% of active managers don't outperform over a 20-year time horizon.
Big number.
What do you think the odds of picking a manager who does outperform over 20 years are?
I would say very small. And if somebody can do that consistently, I would like to meet them.
Yeah, me too. And also, like, who's managed the same product for 20 years? Almost nobody. So there's this persistent underperformance, and it's often hidden by survivor bias, but it's real, it's factual. If this is from a SPIVA study, if you don't believe us, go to ChatGPT. The answer is there. These are facts. And so we want to deal in facts. And if your advisor is a pure fiduciary, they're supposed to be doing what's in your best interest. And clearly, advising you to use passive tools seems to make more sense. But this is before tax. So let's see what it looks like later.
And so what that really means is if you have a manager who's not using passive, you really should push them on why, because either they're saying they're part of the 7% that can really identify this, or they have to give a good reason why you're almost certainly paying higher fees to underperform.
I like that. Are you part of the 7%?
Yeah.
Question. Are you part of the 7% that's going to outperform over 20 years? If you actually look at Barron's rankings of like hedge funds and managers, and you go back and you look at from like 10 years ago, the top funds, they're all different. They're all different. They're all different. There's no persistence. So what do things look like after tax? Talk about that.
Yeah. So, I mean, we spend a lot of time talking about kind of top line before tax performance, but like every client knows, you really eat after tax performance. And there is really an additional drag that we see from active management versus passive. And we can see that post tax, if you take the S&P as the passive, the after tax is 7%. And if you take a large cap core active approach, the after tax is down to 4.9. So, the underperformance is magnified on an after tax basis.
You're really getting, if you look at this on an after tax basis, an active manager in equities in a large cap space, it's really giving you the return of a bond. And
A lot more risk.
Yeah, a lot more risk, and 7%. But it's also just think in your own mind when you're looking at this. So I'm giving up somewhere between 1 and 1.5% to taxes on my investment in a passive product, and more than that in an active product, because an active product is going to buy and sell more frequently. So this is
What does that look like over time? We'll show you.
it looks bad. So the impact of compounding on $10 million investment, passive versus active, is unbelievable over time. So that was the same investment, the S&P versus the average active manager. The difference in 20 years is 12.6 million.
On a $10 million investment. I mean, that is meaningful.
3.5 million on 10 years, 3.5 million. That pays for a beautiful condo in New York City. And on a 5-year basis, it's 1.3 million. It pays for a really nice boat. So these are meaningful numbers. And if we go out farther, obviously they compound more. So why would you use an active strategy if you were a financial advisor?
Yeah. I mean, you really shouldn't be. And I would say this is a strong argument for passive. We try to do one step better in the fact that when we use direct indexing, and we can show you here, we get some kind of tax alpha from the fact that these can tax loss harvest. So, you can see if you look, this is our cumulative return of our direct indexing. You can see that the after-tax performance, the cumulative since inception of March 2020, is 97%. That's actually higher than the gross performance over that time, which is 94%. So you're getting some benefit.
And the benefit you're getting is when you say passive direct indexing, it means that you're replicating an index by owning the individual stocks in the index for, with us, 15 basis points, 0.15%. The manager takes daily tax losses, and those daily tax losses are used to offset your capital gains. So, it's a material benefit. It can be anywhere from 0.3% to 3% in a given year, depending on how much volatility is in the market. But it does allow you to actually beat the index over time, which is, you're still going to pay taxes on dividends. That's not avoidable.
So how about fees? I guess the third thing we wanted to kind of cover on here are fees. Fees, I would say, are something a lot of clients don't actually know what their fees are. And then when they find their fees and they compare them to, let's say, our fee, which is a maximum of 50 basis points, and they may be paying 100 basis points, they say, it's not that big a difference, it's higher, but what's 50 basis points? Well, I think, Pat, once again, we'll show you what 50
basis points is basically millions of dollars. It's millions of dollars. And over 20 years, it's just a lot of money. You're giving someone millions of dollars more. You're paying someone millions of dollars more over a 20-year time basis to do exactly the same thing. This is something that people really need to think about, because you're not getting any value for that fee. If you should be passive, then you should also be paying attention to fees, right? Fees are a part of the reason why passive outperforms. And I think it's very important. These are principles that we believe in because they're facts. They're not opinions. Kind of wrapping this up, fees act like reverse compounding.
Yeah, it is powerful. We say how important a concept compounding is, and fees are compounding in reverse. So it's really important to know what they are and to minimize them.
Right. And even something as low as our direct index fee is 0.15%, and that's cheaper than most other big firms charge on a direct index. And you might say, well, 5 basis points, 10 basis points, it doesn't matter. It really actually does. It does matter. And if you're going to have your capital invested for 50, 60 years, these are things that are worth paying attention to.
And that's why we are consistently talking about them, and we're consistently looking for things at lower fees. If you look at the evolution of markets, they're squeezing fees and lowering costs for the investor, and you ought to be benefiting from it, and your advisor ought to be making you benefit from it. You see us talking about that with evergreen funds. You see us talking about that with direct indexing. So really, an informed client is our favorite client, because they understand really well what we're doing, which is working in the best interest.
And if your advisor has you in active management and he's charging you 1%, ask him, so we own the 7% that are going to outperform, and the 0% that outperform after tax. Ask the questions. These are important questions to ask. There's a difference between being a fiduciary and being a broker. And we are fiduciaries, and we're trying to give you the best answers for the long run. We don't know what's going to happen tomorrow morning. No one does. But we do have opinions, and we do make bets longer term. But we're going to try to use passive tools to express a point of view. We're going to try to control costs, control fees, so that you can win.
Thanks again.